Ever feel like you're just drowning in rising prices?
Yeah, like you're caught in a riptide,
Exactly. And the word on everyone's lips these days is inflation.
right? It's scary stuff.
But behind those scary headlines are these almost like puppet masters, pulling all these economic strings.
You mean central banks?
Yes. And their main weapon, monetary policy. That's our deep dive today.
And you've come to the right place because we're dissecting this IMF fact sheet on monetary policy and central banking.
Which is way more than just some boring economic theory, by the way.
Absolutely.
This is about real effects on your money. Like, we've all heard about central banks buying up bonds like crazy.
Like they're on a shopping spree.
Yes. But how does that actually do anything to stop inflation? It seems like more money would just make prices go even crazier.
Okay, so think of it like this. Imagine a rare Beanie Baby
Right.
that everyone wants. Now imagine someone floods the market with fakes. Suddenly the price plummets.
Interesting.
It's the same principle, but instead of Beanie Babies, it's money itself.
Okay, so more money in circulation can mean each dollar is worth less.
Right.
Hence, inflation.
Exactly.
But by buying bonds, central banks are trying to make borrowing cheaper so people spend more, which should get the economy moving.
Yeah, it's like jump-starting the economy.
But if they do it too much, then we get runaway inflation. It's a tightrope walk.
And this fact sheet gets into all the ways they try to pull that off. It really is like a constant game of economic Jenga.
Right. Too much tightening and you risk a recession, but too loose and you get inflation.
Exactly.
They're like these economic wizards trying to keep all these balls in the air.
That's a good way to put it.
Now, this fact sheet uses this term quantitative easing, which I have to admit sounds a little intimidating.
Well, it can be.
Is that just a fancy way of saying they're printing more money?
It's more like breaking out the economic defibrillator when things get really dire. Imagine 2008, the financial crisis, everyone is panicking. Quantitative easing is like this massive injection of cash straight into the heart of the system.
Wow, so it's kind of like economic life or death?
In a way, yeah.
So it's more than just changing interest rates. It's about just flooding the entire system with money when things just completely lock up.
You've got it.
But it's not without its risks, right?
Not at all. This fact sheet actually talks about that, how it could lead to bubbles and distort things in the long run.
Right. So if things are going relatively well, they mostly stick to those open market operations you mentioned earlier.
Right.
Buying and selling bonds to kind of nudge interest rates up or down.
Yep.
It's amazing how these actions, which are often happening behind closed doors, can affect everything from how much my morning coffee costs to my retirement savings.
And it's global. It's not just their own economies that central banks can steer their actions, also impact the value of their currencies.
Right. Which gets into that whole exchange rate thing. This is what always blows my mind.
I know.
This fact sheet does a good job, though, of connecting the dots between a country's interest rates and its currency. Can you kind of break that down a little more? Because sometimes it feels like voodoo economics.
Okay, so let's say you're an investor with a bunch of money.
Okay.
And you just want the best return on your money, right?
Sure.
Let's say the U.S. Central Bank suddenly raises interest rates higher than, say, Europe's. Suddenly, taking your money and buying U.S. bonds looks way more appealing.
So more people want dollars so they can buy those bonds, which increases demand, and bam, the dollar goes up in value.
You got it.
But doesn't that make things that the U.S. produces more expensive for other countries?
Right. It's a trade-off.
So it could end up hurting companies here who are trying to sell their stuff abroad.
Yeah, it's a real balancing act for these central banks.
Totally. And it gets even more complex because they have this other tool they can use, according to the fact sheet, called macroprudential policies. It's
like those safety regulations you see on a roller coaster.
okay.
Monetary policy is about controlling the speed and direction of the ride.
Right.
But macroprudential policies are there to make sure the whole thing doesn't completely go off the rails.
So it's less about the day-to-day and more about preventing these catastrophic crashes.
Exactly. They're looking for things that could bring the whole system down.
Oh, wow.
Like if banks start lending money to anyone with a pulse or a housing bubble is about to burst.
Okay, so it's about those systemic risks.
Right.
That's a big job. How do they even wrap their heads around something that big and complicated?
Well, they do things like stress tests,
Oh, yeah.
where they basically pretend like there's a financial meltdown and they see if different parts of the system can handle it. Or they might impose stricter rules on lending to try to stop those bubbles in the first place.
It's like they're playing 4D chess with the global economy or something.
Pretty much.
It's no wonder most people find this stuff really confusing.
I know.
But you know what really gets me is just how much responsibility these central bankers have.
Well, for sure. They're making decisions that impact millions
Billions.
of people. And they're doing it without knowing everything that's going to happen.
Right, they're trying to predict the future.
Exactly. The future of a system that is constantly changing and super complicated.
And they have to make everyone happy, which seems impossible.
It's tough. Like we were saying earlier, if they raise interest rates, it might help with inflation,
Right.
but it could also cause the economy to slow down and people could lose their jobs.
It's a real dilemma. There's just no easy answer.
And that's what makes this whole thing so fascinating. It's not just about numbers and economic theories. It's about understanding the trade-offs.
And the unintended consequences?
Yes, and how adaptable they need to be.
Absolutely.
And, this IMF fact sheet actually talks about the challenges that central banks are facing right now.
Yeah, it definitely feels like uncharted territory.
For sure.
We haven't seen inflation this high in decades, and then you have all this geopolitical uncertainty on top of that.
It's definitely a pivotal moment. Whatever these central banks do over the next few years is going to have a huge impact.
So are they changing things up? Are they throwing out the old playbook and starting over?
Kind of. They're having to dust off some of those crisis-era tools like quantitative easing,
Right.
but they're also thinking outside the box.
Interesting.
Like we're hearing more and more about how they can incorporate climate change into their decision-making.
Wait, so climate change is affecting interest rates now. That's not something you hear every day.
It's all connected. Climate change is a huge risk to the entire financial system.
Okay.
So central banks are starting to consider that in their models and how their policies might need to change to deal with it all.
Okay, so how could climate change possibly affect something like interest rates? It's crazy to think that something like a hurricane could affect if I can get a loan.
I know, it's wild, right?
So how does that even work?
Well, think about all the risks that come with climate change.
Okay.
More extreme weather means more damage,
Right.
more insurance claims, and that could lead to more people defaulting on their loans.
So a central bank would have to figure all that into the interest rates?
Exactly. They might have to raise rates just to control inflation,
Right.
but raising rates could also make it even harder for people to recover after like a natural disaster,
Oh, wow. Yeah, you're right.
which would obviously hurt those areas even more.
So it's like this whole other layer of complexity they have to consider.
It really is.
Yeah.
And it just goes to show how much this is all changing.
Yeah, this is starting to feel like we're getting a preview of a whole new world of economic problems.
In a way we are, and central banks are going to have to adapt.
For sure.
They can't just focus on what's happening right now. They also have to try to predict the future.
It's like they're playing chess, but the board keeps changing on them.
Absolutely.
Yeah.
And it's why it's so important to understand this stuff.
Right.
It doesn't matter if you're an investor or a business owner or just someone planning for the future. These decisions affect all of us.
That's a really good point.
It's everywhere you look.
This has been a really fascinating deep dive. I feel like I've learned a lot.
Me too.
I feel like I finally understand a little bit more about how these decisions are made.
And hopefully you're starting to see just how complex it all is
Definitely complex.
and how important it is to be part of the conversation.
Right. Central banks have a lot of power, but they're not perfect.
Not at all.
So what's the takeaway here for our listeners? Should we all become economics experts and start writing to our central bank governors?
Well, it wouldn't hurt to understand a little bit more about economics.
Yeah.
But really, I think it's about staying informed and asking the right questions.
Being engaged.
Exactly. Engage the conversations about the role these institutions play in our lives.
I love that. It's crucial.
This IMS fact sheet has been a great place to start, but as always, it's really just the beginning.
Yeah, for sure. I would encourage anyone listening to keep learning and don't be afraid to ask tough questions.
That's how we all learn.
And who knows, maybe someone listening to this right now will be running a central bank someday.
I hope so.
Thanks for joining us for this deep dive.
My pleasure.
And until next time, happy diving.